Mr. Pritam Singh highlighted the performance of GIC and asked for more information on GIC's investments. Let me start by clarifying how GIC has performed. The mandate that the government has given GIC is to achieve good long-term returns in order to preserve and enhance the international purchasing power of the reserves that GIC manages. Consistent with this mandate, GIC's portfolio performance is evaluated not just on the returns within a single year, but on a continuing basis over the long term. And in particular, we look at the annualized rolling 20-year real rate of return of its portfolio, which GIC publishes every year. This 20-year return in recent years has been lower than that in previous years, and Mr. Singh has highlighted this and also highlighted what GIC, the explanation that GIC has put out for this decline in the 20-year return, which is firstly because the high returns earned in the run-up of the tech bubble in the late 90s have dropped out of the past 20-year period, while the subsequent bursting of the bubble and the decline in asset values has remained within the 20-year window. So that's one reason. The second reason is that the investment environment in recent years has become more difficult, and that is so not just for GIC, but for fund managers everywhere. Nevertheless, in these challenging market conditions, GIC has done creditably. And over a 5-year time frame, GIC's nominal return was 6.6% in US dollar nominal terms. So it has continued to generate positive returns on its portfolio. What I have explained is published in the GIC annual report. Every year's annual report includes an extensive write-up on how GIC manages its portfolio, including its investment methodology and risk management framework. While the relevant measure for its long-term mandate is the rolling 20-year return, which I just highlighted, GIC has also been putting out more information in its annual report. For example, it publishes other indicators, including its rolling 10-year and 5-year nominal returns, and how they compare against a typical market portfolio adopted by large global investors. So the information is there. Mr. Singh would like even more short-term indicators. He has asked for annual indicators. But it is well accepted in the investment world that a requirement to report short-term performance leads to short-term investment behavior by fund managers. And this is especially important because market booms and downturns are a common feature of global markets. For example, if there is a market downturn, a short-term investor will try to unwind its holdings to cut losses so as to limit the damage to its short-term performance. By contrast, a long-term investor will be able to look at fundamental valuations and ride through short-term market cycles so as to achieve better long-term returns. This is, in fact, a major strength that GIC has, and it is important that we continue to preserve this long-term orientation. If GIC puts out annual indicators, there is the inevitable risk that this will incentivize its fund managers to be more mindful of short-term investment outcomes. And I think this will weaken and undermine GIC's strategic advantage as a long-term endowment fund. I should also clarify one point about how GIC, that while GIC reviews its past performance over 5, 10, and 20-year periods, this is categorically not the basis for estimating its future performance. As the government has explained several times before in the House, including when the Constitution was amended for the NIRC framework, the process of estimating long-term expected returns of GIC, as well as that for the MAS and Temasek, rests on a thorough professional assessment of the future investment environment. Such assessments are reviewed by MOF. The government then proposes these long-term expected return rates to the President, who does a further independent check as advised by the Council of Presidential Advisors. So there is a robust system in place to determine and evaluate the long-term expected returns. And as we have explained in this House, and the GIC annual report also highlights, there are reasons to expect a weakening of investment returns for serious, diversified global investors over the next 20 years compared to the past. And this is due to structural headwinds in the external environment. For example, demographics, elevated debt, and low productivity in many countries.